Saving was the easy part. Spending it down is the math. Every retirement spreadsheet answers one question: am I on track? Almost nothing answers the harder one, which starts the day the paycheck stops. Three forces collide there. Required distributions force income out whether you want it or not. Social Security is taxed against thresholds fixed since 1984. And the order your returns arrive in decides whether the same average lasts 30 years or 19. Meet the sample household that ships inside. Dale and Nora Whitfield are shipped sample data, not customers, not a case study. They file jointly, plan to spend $112,000 a year, and hold $1,632,000 across taxable, tax-deferred, and Roth accounts. The dashboard answers the first question. The money lasts past 97, and it costs $305,847 of tax to get there. This is the engine. 30 years, one row each. What they spend, what Social Security pays, what the required distribution forces out, what moves to Roth, which account every remaining dollar comes from, the tax, and the closing balance. Nothing here is typed in except the conversions. Chapter 1. Almost everything written about required distributions says 72. That has been wrong since 2023. Born 1951 through 1958, your applicable age is 73. Born in 1960 or later, 75. Dale, born 1958, starts in 2031. Nora, born 1961, in 2036. One household, two different cohorts of the law. And if you were born in 1959, the honest answer is that it is unresolved. The final regulation leaves that subparagraph reserved. The proposed one says 73, and the workbook tells you so. And here is the trap, priced in your own numbers. You may defer that very first distribution to April the 1st of the following year, and two taxable distributions then land in one calendar year. $17,853.62 plus $16,892, $34,745.62 stacked into one return. The grace period defers a deadline, not income. Chapter 2. Between the day the paycheck stops and the first required distribution, your taxable income is the lowest it will ever be again. Their window is 5 years long, and it holds $954,554 of room underneath the top of the 22% bracket. Their plan uses $450,000 of it. The other $504,554 expires when the distributions switch on. And used bracket room is the one thing here you can never get back. Chapter 3. Conversion income is ordinary income, and it stacks underneath your capital gains, lifting them out of the 0% rate. Across this plan that pushes $70,109 of gain out of the 0% band. And inside the Section 86 phase-in, every extra dollar of ordinary income makes up to 85 cents of your Social Security taxable too. $45,758 of it here. Which is why the rate they really pay per converted dollar is 14.3%, and why 1 year here reaches 21.1%, while the bracket still says 22. Chapter 4. 9 claim ages, priced. Dale's full retirement age is 66 years and 8 months. Claim at 62 and he gets $2,135.67 a month for life. Wait to 70 and it is $3,774.67, 26.7% more, because credits accrue at 8% a year and stop dead at 70. The lines cross at age 80. But break even is only half the question. While both are alive, the household receives $67,436 a year. When the first of them dies, the survivor keeps the larger benefit, $45,296, and loses the smaller one entirely, $22,140 a year, forever. In the same year, their standard deduction and Social Security base amount both drop to the single filer figures. Delaying the higher earner's benefit is insurance for whichever of you lives longer. Chapter 5. The one that changes what people do. 2 columns. Same $1,632,000 portfolio. Same 4% withdrawal. The same 30 returns, averaging 7.3%, identical to 8 decimal places in both. The only difference is which end of the list the bad years sit on. Bad years first leaves $562,244. Bad years last leaves $5,154,000. For $1,437,910 apart, and nothing changed but the order. A bad year while you are drawing down is a forced sale. You sell more shares at a lower price, and they are gone before the recovery. Sequence risk is asymmetric to saving. Only someone drawing down is hurt. For 1,633 formulas across 14 connected tabs, recalculated clean before filming, 0 errors, and every derived figure recomputed independently in Python. 1,016 out of 1,016 checks passed. Every screen here is that real file. Now the part that matters most. This is a planning tool. It is not tax, legal, investment, or financial advice. A 30-year projection built on one return assumption will be wrong, which is what the sequence risk and guardrails tabs exist to show you. State income tax is not modeled. And 2 corrections. The one big beautiful bill did not end tax on Social Security. It created a separate $6,000 per person deduction for people 65 and over for 2025 through 2028 only. And there is no published 2027 Medicare IRMA table, so this file does not print one. Confirm anything that matters with a CPA or a fee-only fiduciary planner. 2 birth years, 2 claim ages, what you plan to spend, and your accounts. What you get back is 30 years of answers. Which bucket every dollar comes from, what it costs in tax, and how long the money lasts. The Command Center is $32.97, one-time, free lifetime updates, Excel and Google Sheets. Spend it down on purpose. Link in the description.